Good afternoon, everyone. I'm Jeff Newcomb, the Deputy Chair of NGS Super. It's a privilege to welcome you to our second annual member meeting. Once again, we're unable to hold this meeting face to face, so we hope the technology will be kind to us. Joining us remotely today are NGS Super's 12 directors, the CEO and members of the executive team, as well as our auditor from PwC, Ben Tomset, and our actuary from Mercer, Tim Jenkins. I welcome them and thank them for their commitment during the year. This annual general meeting will work in the same way as last year's. I'll make a few comments, then our CEO, Laura Wright, will address the meeting, and finally, our Chief Investment Officer, Ben Squires, will provide a report. During the meeting, you can ask a question by typing your question into the field on your screen in the Ask a Question box underneath this video player. After Laura and Ben conclude their remarks, your questions, as well as those previously emailed, will be answered in the allocated time. All questions and answers, as well as a video of this meeting, will be up on the NGS website by the 17th of December. Please note that we cannot answer any questions that relate to your personal circumstances. This year has been one of significant disruption and many challenges. While we are all extremely wary of predicting what next year might hold, our focus will continue to be on providing the best returns for our members. Throughout much of 2020 and 2021, like most businesses, as a fund, we've been accustomed to working remotely. While this has its challenges, I'm very pleased to acknowledge today the commitment and dedication of all the staff of NGS Super. The best outcomes for our members is their passion and their driving force behind everything they do. Before Ben Squires reports on the work of our investments team, I'd like to mention the fund's target of a carbon neutral investment portfolio by 2030. This is an ambitious and important goal and a testament to the future focused thinking of our investment team and of our fund. I'm aware that there have been a number of questions via email about the board's decision not to proceed with a proposed merger with Australian Catholic Super. When we entered into the merger process, it was with belief that this merger would be in the best financial interests of our members. This is, after all, our sole purpose: to provide the best possible retirement outcomes for you. However, over the course of the merger negotiations and discussions, it became clear to us that the merger would not be in your best financial interests. This was not, of course, a decision we took lightly. I'll now hand over to our CEO, Laura Wright. Again, thank you all for attending today's annual member meeting.
Thank you, Jeff. I'd also like to welcome all of you to the annual member meeting. This is a great opportunity to talk to you about what the fund is doing, but also an opportunity to answer your questions. As you're joining us remotely, there could be issues, and you'll notice that there's a contact support button at the bottom right of this page. And if you have problems, please click on that, enter your details, and including what the problem is, and one of our people will contact you. Well, what a year we've had. Like last year, I call it a year in two parts. So between July and December, we're all working from home. And then we came back in the new year to what might be known as the new normal, only to then return to a lockdown situation from June. Hopefully, 2022 will see all of us in a more new normal. I'd like to take the opportunity, though, to really thank our members who work in education, and in health and community and aged care for all that you've done to support families and the community through this incredibly difficult and stressful time. Now for some good news on the investment front. The diversified MySuper had its best return in 10 years and the second best return for the fund since inception. The return for the diversified MySuper was 17.3%. I'm also very proud of what we've done in the target we've set to be carbon neutral by 2030. We're the only super fund to set such a target, and our Chief Investment Officer, Ben Squires, who'll be talking to you later, will give you some information about how we're progressing in achieving this target. In December, we also submitted our first report to the Task Force on Climate-Related Financial Disclosures, a major undertaking. And now for the merger. I know that last year we talked about the possibility of this merger with Australian Catholic Super, and it is disappointing that it didn't go ahead. We had 12 months of discussion and scrutiny, but the conclusion the board drew was that the merger was not in the members' best financial interest. There would not be a reduction in admin fees and there'd be limited opportunity to reduce investment fees. The board now is reviewing the current situation of the fund and assessing the various views that there are about size and the impact of size on costs, fees and returns. And we'll keep you updated with any news on this front. Our time at NGS is spent very much focusing on member outcomes. Obviously investments being the key one, and Ben will talk in a great deal of detail about what we've been doing in the investments area. But the other outcomes that we've set for members are around insurance, advice, fees, service and governance. I'm just going to briefly touch on these to let you know what the results are for the year. On insurance, we're very proud of our insurance at NGS Super. We've been nominated 8 times for the Chant West Best Fund Insurance, and we've won it 4 times. Insurance is something that is highly valued by our members, and we have noticed during this period of uncertainty with COVID that a number of people have been reviewing their insurance and increasing cover. Advice is increasingly important, particularly for our members who are nearing retirement or at retirement. COVID's provided a lot of additional opportunities actually with the rollout of quite an extensive webinar program, providing access to financial information and advice to a much broader range of members. We'll be continuing this virtual program in conjunction with, of course, resuming our face-to-face advice and the telephone advice as well. Now for fees. I'm very happy to say that our admin fee has not increased since 2006. That's an absolute major achievement, to be able to continue to provide you with the products and services that you expect from NGS Super without an increase in the admin fees. Our daily unit pricing came in at the end of December, and I know that was very welcomed by many of you who are following our investment returns very closely. I note that we have had to increase some of our investment fees recently, and the reason for that is that there is a higher transaction cost with some of our trading activity, but also something that's a plus, that we pay a performance fee when there's outperformance, and that's something that you would be hoping that we'd be able to do on a regular basis. It's very important to the bottom line with investment returns. As for service, our administration services are rated very highly by Super Ratings, and we continue to have a high member and employer satisfaction. Now for the area of governance. I think many of you would be aware of the enormous scrutiny there is now on superannuation via the regulators, particularly APRA and also ASIC. So Fund is very focused on ensuring that we're continually improving our areas of governance, that we're meeting all the regulatory requirements and standards, and that we're managing any of our complaints and incidents in a timely and very member-focused way. Regulatory reform. I've mentioned the two regulators. It's continued unabated for all of this financial year, and I think members should be pleased that that has happened, because superannuation is a very large financial investment for members, and it's important that you have the satisfaction and security of knowing that your money is well managed. Some of the regulatory reform has been positive. Very good to see that the superannuation guarantee moved to 10% after efforts to try and stop that increase. Also for our pension members, I think it was good that there's been another year where the pension drawdowns have been reduced, allowing members to recoup any of the losses you might have had during COVID. One of the new changes that's going to be very interesting for NGS Super is the concept of stapling, where people will stay with the first fund they ever join unless they make a choice. This situation could be quite challenging for a fund like NGS Super, which of course is not the first fund that most people join. Again, I mention APRA. It continue to relook at the standards. In particular, there will be new standards for insurance, remuneration and investments. And most of all, on 1 July in 2022, we'll be introducing the approach to the retirement covenant. This is obviously the whole purpose of Super, retirement outcomes, and so I think it's an important step that funds are now moving their attention more to the pension stage than perhaps we have done in the past. And now for the future. What are we doing about products and services? Well, I'm pleased to announce that we've just recently launched our new app. Some of you might have had a chat to Nina, our new chatbot. We're also planning to release a new online financial planning tool. These are all major improvements into how members can access information and communicate with the fund. Investment options. We're continuing to look at whether our investment option suite meets the needs of all of you and that it remains relevant. As part of improving our approach to investments, we've actually working on the implementation of a new investment database, which will very much help with better information for investments to help us make appropriate investment decisions. I talked about our award-winning insurance, and it's not something that we just have a set and forget approach to. What we are doing is every 3 years with our insurer TAL, and it's happening in 2022, we'll be reviewing our insurance offering, looking at where we need to change or enhance the products and the features of that insurance product, and also look at premiums. It's really, really important that premiums are appropriate and do not erode your retirement benefit. I've previously mentioned the focus that we'll have on retirement and developing a strategy to meet the retirement covenant. And as far as general member experiences, we're always continuing to try and enhance our website to make sure that there's good functionality there for members and the information's appropriate. We always have a big focus on education because that's very important, empowering you, the members, so you can feel comfortable with the decisions you make about your super. And also, I previously mentioned, we continue to expand our webinar program. At NGS, we're really committed to continual improvement and delivering on member outcomes. I'll be looking forward to the questions that you put forward as a result of this presentation and also what Ben talks about later. Thank you for being with NGS Super, and I'll now hand over to Ben Squires, our Chief Investment Officer, for a report on NGS's investments. Thank you.
Thank you, Laura. Once again, it's a pleasure to provide you with an update on the fund's investment activities and performance today, and thank you for your attendance. Following on from the opening remarks from the Chair and the CEO regarding investment markets, 2021 will be remembered as the second highest annual returning year by the default option in the history of the fund and the highest return in over a decade. As economies reopened globally in the later stage of 2020, share markets accelerated along with credit markets and property prices as investor appetite for risk was insatiable, with extreme levels of positive sentiment reached across both corporate and consumer indicators. It was another busy year of investing across the fund. We added 28 new investments to the portfolio. This equates to approximately $1 billion worth of commitments, with $600 million of this invested over the last 15 months. The efforts to decarbonise the portfolio were formalised, with the first task of measuring the carbon intensity across the portfolio being completed. In addition, scenario analysis as part of developing a transition plan is underway, and these results will be reported to members in the first quarter of 2022. Today I'm going to discuss the economic conditions over the year and how the portfolio was positioned. I'm then going to discuss the performance through the lens of the diversified My Super option and the sector contributions to the overall return for the 1 year ending 30 September 2021. I'm going to provide an update on other activities across the year, including our efforts to decarbonise the portfolio. And lastly, I'm going to look at our preferred asset allocation and expected returns across those assets over the next 12 months. The global economy has rebounded from record low levels, and the chart on the left shows how the Purchasing Manager Index, also referred to as the PMI, has recovered from the lows of 2020. This is an important forward indicator showing the health of the economy. A reading above 50 indicates that the economy is expanding, which is the current state of economic activity. The Delta outbreak in the early parts of 2021 saw economic growth slow, but it has continued to remain positive, and this condition provides support for share markets as they advance to all-time highs off the back of increased company earnings. And this can be seen on the clip of the right-hand chart, which shows the performance of global share markets rising sharply following the lows in March-April 2020. Strong economic conditions provided significant positive momentum in share markets at the start of 2021, as we saw continued amount of liquidity, that is, central banks purchasing government bonds to ensure that the borrowing rate for consumers and businesses remained low. The bottom clip in the right-hand chart plots the percentage of central banks easing policy. Again, in the early parts of 2020, monetary policy was extremely supportive, and although the rate of expansion has contracted, it continues to remain in positive territory, and this environment is expected to support share markets. Inflation risks rise. Is the cause of inflation permanent or temporary? This chart shows that inflation has risen sharply across the largest developed economies. In the early parts of 2021, the market became increasingly concerned with this higher inflation reading, and this saw yields rise within fixed income assets as markets anticipated higher interest rates in the future. This spike in inflation and yields also resulted in some leadership changes within share markets and led to more volatility during September 2021. Central banks were quick to respond to try to reassure markets that inflation was indeed transitory, caused by changing consumer consumption patterns arising from lockdowns and not to be expected to be permanent. The higher inflation results pose a risk, however likely to be transitory as a result of negative output gaps, long-term disinflationary trends such as technology, globalisation and demographics. It's likely that these factors will keep inflation anchored in the immediate to long term. So what is driving inflation higher? Unprecedented fiscal and monetary stimulus combined with COVID-induced consumption of durable goods, which is shown on the top clip of this chart. The spike in demand for goods was met with supply bottlenecks transportation, freight, logistic challenges, and general lockdown conditions. These factors are expected to remain under pressure for some time, whilst labour shortages plague businesses. Productivity has improved markedly, and this has somewhat offset the shortage of labour across many industries. However, labour costs, along with energy prices, raw materials and food, all add to the high inflation readings and present potential risks of more rapid tapering by central banks and rising interest rates. Based on the outlook leading into the second half of 2020, the portfolio maintained a position to growth assets. The key position across the portfolio included increased deployment of private equity investments, an above weighting to an allocation to share markets, a higher allocation to alternate forms of credit, which attract higher rates of interest payments, a higher allocation to value-add real estate and infrastructure, and the lowest allocation to government bonds, fixed income and cash in the history of the fund. Now just moving on to fund performance. As mentioned, this was the second highest returning year in the history of the fund and the highest return in over a decade, with the diversified My Super option as at 30 June returning 17.34%. This strong performance continued throughout September and was also continued through October. And as you can see on this chart, Australian shares, international shares dominate the return, having the highest weighting in the portfolio, followed by private equity, infrastructure and property. And as at September, the return delivered for the diversified My Super option was 17.7%. Now just moving on to some other investment activities and carbon neutral target update. Climate change is one of the biggest risks to humanity and by extension investment portfolios. Those who choose to continue on in a business as usual basis will be exposed to this risk. As most of you would be aware, the fund made an announcement in 2020 on our ambition to reach a net zero carbon portfolio by 2030. Since our last annual member meeting, the investments team have been developing a framework to progressively reduce climate-related risk from the portfolio. I'll now step through some of the activities and our approach to identifying these risks. We know that we only have approximately 800 billion tonnes of CO2 that we can produce to keep temperatures below 1.5 to 2 degrees Celsius. At our current level of carbon production, that's roughly 40 billion tonnes a year, we'll exhaust this carbon budget in 20 years. This puts extreme pressure on the environment and will have catastrophic impacts on the portfolio if it's allowed to continue. This chart shows the 6 major climate scenarios developed by the Network for Greening the Financial System. These scenarios have been developed from the contribution of 66 central banks around the world. It maps the amount of CO2 in the atmosphere and how the level of carbon dioxide impacts global temperatures. The orange line at the top, which begins from 2020, shows the impact on global temperatures if we continue with the current policy regime in relation to decarbonisation. This scenario is referred to the hothouse scenario. The NDC stands for Nationally Determined Contributions. This is the sum of all of the country pledges, and again, this is not enough to see global temperatures maintained below a 2 degrees Celsius increase, and therefore also leads to a hothouse outcome. The final 3 scenarios provide various paths towards maintaining temperatures below 1.5 to 2 degrees Celsius. And we use these scenarios to measure the impact on companies in which we invest. To illustrate this in terms of the 2 major risks we face across the portfolio, transition risk, that is, the risk of companies going out of business as a result of not being able to adapt to a low carbon environment, and this is shown on the y-axis, and physical risk, which is shown on the x-axis. We can determine how companies' value will be influenced based on how the price of carbon increases or remain constant, in the case of the NDCs and current policy scenario. This diagram illustrates that under the NDCs and current policy, we face catastrophic impacts to the climate and natural ecosystem. Transition risk remains low, however physical risk is high under this scenario. We can also expect extreme weather events if we do go down this path. On the y-axis, you can see the degree of impact based on delayed or net zero by 2050 target. And this shows that the transition risk is much higher, whilst the physical risk is mitigated to some extent. We then apply these climate scenarios against each company in which we hold in the portfolio, and this diagram visualises the impact of value. We start with the current value on the left, and we apply the impacts of physical risk, transition risk, and competitive forces to derive the impact to company value. By doing this, we can determine whether the price we are paying for a company is taking into consideration the destruction of value caused by climate change. Not all carbon is equal in terms of the risk it presents to the portfolio. So we split carbon into three forms, and I'm just going to use an example here of oil and gas and coal. What you can see on this chart on the left-hand side, the little red carbon molecules, is effectively the value in the earth from oil, gas and coal stores. We define this as stranded carbon risk. The risk associated with this type of carbon is if we do see further price increases for carbon, then these assets will eventually become stranded as they fail to compete with cheaper forms of energy. We then have a category called transition carbon. This relates to steel companies, car manufacturers, airports, aluminium smelters. This type of carbon we define as transition carbon because it's required to make the transition to a low carbon environment. And lastly, we measure the offsetting or carbon sequestration that we can achieve by investing in clean technology and renewable energy. Now just moving on to the property sector. The portfolio continues to perform extremely well, delivering a 13.87% return as at 30 September 2021. Industrial and commercial continue to dominate the portfolio returns. And as you can see from this particular diagram here, from 2012 we've built up a fortress of 19 properties worth $426 million. We've been able to acquire and land bank assets in adjacent corridors. We're able to effectively build a industrial estate. We also have the option to rezone some of these assets in the future, and that's part of our development plan. It's a similar story in the office portfolio, which was established in 2016, and we currently have $125 million of office assets across the eastern seaboard. There's significant room for redevelopment of these assets, and as part of our forward work plan, we're looking to roll that development plan out, which will increase the value looking forward. We've also had a number of property development investments that we've made and introduced into the portfolio, both across industrial but also in residential. And this example here is a development that's underway in Greenwich in New South Wales. Now just moving on to our infrastructure portfolio. Infrastructure is primarily known as airports, seaports and toll roads. However, the mix of infrastructure assets is quite diverse, and these diverse sets of assets provide different income streams to the portfolio. And these are just some of the examples of assets that we have across the portfolio: water assets, telecommunication, rail, registry services, pipeline and renewable energy. On the renewable infrastructure side, we've invested in distributed energy. We've got a $40 million direct investment that we made in US distributed energy, and it's delivered a 54% return for the 1 year period. This has a strong thematic behind it as a result of the movement in decarbonisation, but also makes a positive contribution towards the Sustainable Development Goals. We've also continued to invest in other forms of infrastructure, And here's an example of a direct investment we made in an Italian and Brazilian toll road operator, a 25 million euro investment, and the current one-year return for that particular asset is 28.29%. We're making further investments with that particular toll operator in 2022. Other areas that have generated superior value for the portfolio in the infrastructure side is power generation. This is again remote power generation for mining sites across Australia, data communication, fibre and cloud infrastructure across Europe, and day hospitals across the eastern seaboard, all delivering extremely strong returns for the portfolio. On the venture capital and private equity side, we've increased our allocation across our portfolio. In the diversified option, it's sitting around 7%. It's generated extremely strong returns for the portfolio with a one-year return of 50%. We continue to build out this portfolio, and in the high growth option in particular, the allocation to private equity is only increasing. I'm now just going to move on to our asset allocation and preferences and expected returns. We continue to invest in people within the investment team, having added 2 PhD qualified professionals along with bolstering the governance and investment operations team. We've increased the level of portfolio disclosure ahead of any regulatory reform, and you can find more information on our website. We've further enhanced our socially responsible investment option by sourcing new private equity and infrastructure investments across healthcare, technology, renewable energy infrastructure, and other technology companies focused on solving some of the mega trends likely to shape the next decade. These investments also feature across our other multi-asset class options. We are actively reducing our exposure to high carbon-based businesses and present a transition roadmap in the first quarter of 2022. As I mentioned, the high growth option is being reshaped to take advantage of the strong pipeline of private equity opportunities. This will result in the option having the potential for superior returns to the market and other options available on the menu. We've increased the panel of external advisors to support the internal investment team to both source new deals and complete diligence on new opportunities. Our base case performance expectations for the year ending 30 June 2022 is approximately 11%. And again, you can see the major contribution to returns coming from Australian and international equities. However, our increased allocation to private equity, opportunistic infrastructure, and other forms of credit are increasingly adding more value to the portfolio, and we expect this to continue in the future. Once again, thank you for joining us today, and I hand back to Laura to answer your questions and provide closing remarks.
Thanks, Ben. Very interesting as always, and you certainly won't just be me answering the questions. You've got a lot of investment questions coming up as well. But I might start with the questions. I will read out the question, as long as it's not too long, where I might summarise it and obviously respond to the answers. So the first question's from Anthony, and it's about fees. Every year gets an annual report, and it tells Anthony about that he's got undisclosed expenses and they don't appear on the report. Why is this so? Is it common practice throughout the industry? And why can't I get the whole information added to the main costings in the report? So with the fees, there are obviously two components of the fees. The first is the fixed admin fee, which is charged weekly and is deducted directly from member accounts. And you will see that on your statement. However, most of the fees are actually based on the value of the assets, and that's what you have invested, and hence are deducted from the investment returns before that's credited to your account. These primarily are costs of managing the funds, and also there's a small asset-based fee. It's the most common form of fee and fee disclosure in the superannuation industry, and with all the information is in our product disclosure statement. Both the Deputy Chair, Jeff Newcomb, and myself mentioned the merger in our opening remarks. And we do have a couple of questions about the merger, so to some degree I'm actually repeating what I've said before. So with the merger, there's two questions, one from Sam and one from Philip. Basically, why did the merger fail? And in particular, was it because of the performance test? As we've stated already, the board, after a long deliberation, determined that the merger was not in the financial best interest of NGS members. There wasn't to be a reduction in administration fees, and there was limited opportunity in the investment space. And therefore, it's not in financial best interest. The decision was taken by the board, in fact, before the performance test results were released. Another merger question, and this one's from Tom. And it's more about the future and just where will NGS be in the future. So as more funds perhaps will fail that performance test and the whole environment becomes more competitive, do you think that over the next 5 to 10 years there'll be more consolidation in the superannuation industry? Does NGS have plans to merge with a bigger super fund, for example Uni Super, given both in the education sector? Well, firstly, yes, there will be more consolidation. The regulator APRA has made this very clear. There's actually about 17 funds that have got more than 10 billion funds under management and over 100 with less than that. So quite clearly, with the smaller funds, there's a lot of opportunity for merging. A fund like NGS Super, which is a mid-size fund, what the board was doing is looking at where we sit and where we stand in the industry, looking at all of the metrics, and then taking a view, obviously, on how much size of fund determines costs, fees and returns. This is an ongoing discussion that's just clearly started because the merger only failed there in September. So early days, but whatever the board decides and is looking at is always with only one purpose, and that is member best outcome and looking at the best retirement outcomes for members. Now I've got a question on insurance, and this is from Dina, and it's basically about who would receive her death insurance, particularly what she's nominating somebody in her will. So I want to make it quite clear that when you've got insurance within super, it's the rules that govern super that govern where your money will go to in the case of your death. What we do suggest that where possible, when members join the fund, that they fill in a nominating form, nominating their beneficiary, and preferably that would be a binding death nomination. If it's a binding nomination, the trustee has no discretion. It must be paid to the parties that are stated in that nomination. If it's a normal nomination form, trustees will use that as a guide, but that does not mean, in fact, benefit will be paid to the people you nominate. There's certain rules that will apply. So it's really, really important to actually do the to nominate, do a binding death nomination. I certainly recommend that to all members. Now for a question more about the operations. And Trevor's got a question that I can really relate to, Trevor, not only for NGS but for lots of places. And it's about improving member experience. Will you make all of your online PDF forms interactive and accommodate electric signatures? Well, yes, that's what we'd be aiming to do. We've got a newly formed customer experience team, and we're continuing to work with our service providers to see how we can improve that online experience, particularly around forms. It's certainly a very mixed bag across all sorts of organisations, and I think we've learned a lot from our experience with COVID about how things can be done differently. And we expect to have some improvements in this area in the next 12 months. And now I'm going to hand over to Ben because we've got quite a few investment questions.
Thank you, Laura. And the first question that I'm going to address is from Tom. Thank you, Tom. There's a number of questions that I will cover for you. Can you please clarify the following points on our fees and the changes in fees? So firstly, there was a question relating to fees and data changes in what was contained in our significant event notice. So fee data is reported to reflect the changing regulatory disclosure requirements. For example, a performance fee is now averaged over multiple years using actual fees, opposed to applying an annual accrual based on estimates. Because performance of the NGS options has been higher, performance fees have increased. So on a net return basis, member outcomes have been stronger as a result. Another question in relation to the addition of new investment options and how that relates to fees. Again, the changes in manager configuration and the appointment of new managers is aimed at generating superior member outcomes. For example, the diversified option invests in unlisted opportunistic assets across private equity, private credit, infrastructure and property. To gain access to these opportunities and specialised managers that are appointed across these options, they're available via the multi-asset class options, and these tend to be more expensive than a passive-based approach, such as the indexed growth option. So for those members and those financial planners seeking low cost, we do cater by offering that indexed growth option, which costs approximately 5 basis points and one of the cheapest investment options in the marketplace. Another question in relation to what's our plan post-COVID with lockdowns, for example, e-commerce, store rollouts, consumer services. So again, we continue to find attractive investment opportunities that exceed the target returns of the portfolio across the majority of areas in which we invest, including infrastructure, property, technology, healthcare and debt instruments. The recovery phase out of COVID is not dissimilar to other business cycles that we've experienced, and the fund has a variety of tools to position the portfolio to take advantage of the prevailing conditions. As a long-term investor, we do aim to invest in companies that are participating in secular trends and therefore are expected to provide excess returns over a meaningful period. For example, we've actively invested in healthcare technology, clean technology, transitional energy assets, day hospitals, agricultural technology, rocket companies, autonomous vehicle technology and quantum computing, just to name a few. Another question from Tom in relation to the consortium that's running through Morgan Stanley to modernise the Victorian motor registry system. These are large investments and generally made by consortiums. Sometimes we do participate in these consortiums through our infrastructure managers. However, as it relates to the Victorian Motor Registry consortium, we aren't participating, nor are our managers. There was also a question about is the New South Wales Motor Registry system planning to be privatised? Not to my knowledge, but again, these opportunities do present themselves. When we are looking for direct investments and to participate directly in consortiums, we are typically targeting higher returns than what you would receive on those core infrastructure assets. And we've made several of these over the last 12 months. A question from Tom around the diversified option, but also from Dina, just asking about performance relative to the peers, such as UniSuper, Australian Super, Host Plus. Now, in relation to performance, the NGS portfolio was designed to generate returns in excess of its objective without taking excess risk, which we have achieved. The NGS portfolio was one of the lowest risk funds in the marketplace. Investments are tailored to suit the risk appetite of members, and some of the comparable funds have a much higher level of risk in their default option. And this can be by design as a result of the demographic in which they're serving. These options aren't necessarily directly comparable with the NGS Super diversified option or default option, rather more comparable with the NGS high growth option, given the level of growth assets that they have. I commenced in this role in 2018, and the current investment strategy reflects the new approach that we're taking that has been supported by the board. and we believe that we will outperform both our objectives and the peers based on this new investment strategy. We have extremely strong investment opportunities in front of us, and the portfolio is uniquely positioned to take advantage of the market conditions. A question from Nancy. This question relates to shares in fossil fuel-based companies and environmentally unfriendly companies. Is this going to be applied more broadly across other options? Well, as you would have already heard, the fund is transitioning away from fossil fuel-based companies, and that applies to all investment options that we offer to our members. You can hear more about this via our social media chats and on the website. We are going to roll out more formally a transition plan, which will be presented to members in the first quarter of 2022. Alternatively, you can choose our socially responsible diversified option that largely addresses all of the concerns around ESG. A question from Philip and Marty in relation to cryptocurrencies. A question that relates to, are we going to offer a particular cryptocurrency option, and do we invest in cryptocurrency? So the fund has actively researched this area and continues to do research, and the merits of cryptocurrency and blockchain more generally are immense. These technologies as a medium of exchange, that is as an anti-fiat characteristics, and given the fact that they are scarce in quantity, make them a very attractive proposition. To date, we haven't made investments in cryptocurrency given the level of volatility in that marketplace, but we continue to do research in this area. And if we do eventually make investments in cryptocurrency, it won't be offered as a standalone product. It'll be, you'll gain exposure through our multi-asset class options. Now I'll just hand back to Laura for some additional questions.
Okay. This question is from Ken, and it's a very pertinent question, Ken, considering the very competitive environment that NGS is operating in. And Ken's question is, I don't see any attempt at advertising for new members. Should we be looking for new members outside the core group, that is independent schools, to grow the fund before we get swallowed up by one of the mammoth funds? Well, Ken, we actually have started, and we've always been out there advertising, but you are right, most of our advertising's been done within our core market. We've started to do some test and learn in terms of expanding past that and looking at broader methods of acquisition. But starting with the social media channels and digital approach, so we are looking at what we can do to broaden our acquisition of new members. So Peter wants to know how big we are. Well, at the end of September, Peter, we had $13.5 billion of funds under management, 111,000 members and 11,000 employers. And there's more detail around this in our annual report, which is on the website. A good question from Heather about the retirement covenant. What is it? And as I mentioned in my report, Heather, obviously the whole purpose of super is about retirement, and it's really good that we're now starting to focus even more on that end rather than just the accumulation. So Treasury released draft legislation to originally introduce a retirement covenant for super trustees. The original proposal was actually for some sort of mandated product, and it was in the budget in 2019. But the legislation now proposes to codify the obligation of superannuation trustees to have a retirement income strategy, which outlines in particular how the fund plans to assist members in retirement. So it's a broad brush. It's not just about product, it's about services and product, but geared to members in the retirement phase. And we'll be providing more information to members clearly on the website, and we will have something in place for 1 July 2022. Back to you, Ben.
Thanks, Laura. A question from Julie. Do you anticipate sustainable investment to be a growth industry, or does Australia's COP26 performance affect its potential? There's no doubt that the economics of decarbonisation is well and truly underway. We're seeing this across industries, across portfolios and across companies in which we invest. So despite the potentially slowdown of policy change, which is disappointing, the investment in clean technology, in sustainable investments will continue to grow over time as high carbon emitting businesses, the cost of their capital increases at the expense of new technologies. A question from Rachel. What have been the primary ESG activities which NGS has undertaken in the past year, and how have past ESG activities been progressing? So as I mentioned in my update, there's been a significant amount of work by the investment team over the last 12 months. We've modelled out the carbon intensity in our portfolio. We've run scenario analysis across the companies in which we own, and we're now in a position where we can validate some of the key decisions around divestment and future investment that we're making. And this will be presented to members in the first quarter of 2022.
Did you have any more questions there, Ben?
I think that's it, Laura.
Okay, well, has been very interesting. It's really pleasing to see. It's really pleasing to see that members are taking so much interest in the fund, but particularly in investments, because after all, it's your money, and you need to be satisfied that we're doing what you would expect us to do to get the best outcomes for members. Now, I think that's the end of the questions. So again, a great variety from members this year. So I want to thank you for that. And in terms of wrapping up, firstly, obviously, I'd like to thank Jeff and Ben for their presentations, but also none of these events are possible without a lot of people behind the scenes, and of course that's the NGS staff who have been involved in organising this event, and the Carivium staff who we worked with last year who've been fantastic with all the technology and the camera work. But most of all, from the staff perspective, the board has shown great support and guidance for the staff, but also the member focus that the board also always has, and for the fund staff. I mean, they're very, very committed to members. That's all we're interested in. That's all we talk about, member outcomes. But of course, the fund is nothing without you, the members. We're very, very grateful for your support, for your encouragement, and particularly for your interest. It's great that you've been able to attend today and to show such an interest in your fund, and we look forward to engaging with you further throughout the year at our various forums and webinars, but also next year at our annual member meeting. Thank you for attending.
Thank you.